Welcome to a quick dive into Delek Logistics Partners, ticker DKL, a high-yield midstream on the NYSE. Current price about $43. I'm your name. Today, strengths, weaknesses, dividends, and whether DKL fits an income portfolio. Quick summary first, then the numbers you need to know. Let's get started. Delek Logistics is an MLP focused on pipelines, storage, and transport in the Permian Basin and the Southeast U.S. Its cash flows come from long-term contracts, including work with parent Delek U.S. Holdings. Let's break down pros and cons. Pros: first, stable cash flow from long-term contracts. Second, a juicy 10.4% dividend yield, attractive to income investors. Third, the 2025 gravity water acquisition boosts third-party revenue and diversifies income. Now the cons. First, a sizable debt load, about $2.15 billion. Second, sensitivity to oil price swings and the long-term shift to renewables. Third, higher leverage than some peers like Kinder Morgan, which can mean less flexibility. Net profit margin sits near 16.6%, slightly up year over year. So income appeal is strong, but leverage and energy transition risk are real headwinds. The $2.15 billion debt is high, but operating cash flow currently covers interest and distributions. Distribution coverage runs roughly 1 to 1.2 times. Adequate, but tight. High interest costs limit capital flexibility for growth or debt paydown. Side revenues, third-party logistics and water management, now make up almost 30% of income after the gravity deal. That diversity helps stabilize cash flow outside parent company contracts. EBITDA last quarter was $120.9 million, up 18% year over year. Since the 2012 IPO at $21, total return including dividends is about 488%. That turns 1,000 into about 4,900, a roughly 5% annualized return under long-term S&P averages. So DKL pays well and has delivered strong total return, but growth is more modest versus broad equity indexes. Next, what to expect toward 2030 and beyond. DKL is betting on Permian expansion near term, which could support volumes into the 2030s. But long-term strategy beyond that is less certain. By 2040-2050, EV adoption and renewables could reduce oil transport demand. Political or regulatory moves tightening fossil fuel activity would also hurt the business. Conversely, high oil prices or energy security needs can boost margins and cash flows. Dividends. DKL has raised payouts for 47 straight quarters, paying about $4.46 annually, reliable for income seekers, though MLPs aren't dividend aristocrats. That consistency matters for income-focused portfolios. Over 1 year, DKL returned 24%, beating the FTSE and roughly matching Japan's Nikkei. 5-year returns are about 103%. Competitive, but much of the appeal is income rather than high growth. Compared to peers, Enterprise is more diversified with lower leverage, while MPLX has grown margins 2 to 3% annually versus DKL's 1 to 2%. Is DKL a buy? For income investors seeking yield and steady distributions, yes. Its 10% yield and contract cash flows are compelling. But growth is limited, debt is high, and energy transition risk is real, so balance exposure accordingly. For more breakdowns, hit subscribe. Disclaimer, not financial advice. Do your own research. Thanks for watching.